Thanks so much for stopping by. I'm Linda.
Sarah, nice to meet you.
Hi,
Taylor.
Rebecca, nice to meet you.
Taylor, nice to
Rebecca.
meet you.
Please take a seat. We've appreciated the recommendations you guys suggested in your proposal. As we previously mentioned, we are now facing another issue concerning which machinery to invest in. We're interested in hearing your thoughts.
Based on our analysis, we have come to the conclusion that option 2, the investment in the labeling machine, would be the best fit for Humble Pies from a strategic, financial, and risk standpoint.
While it first appears that option 1, the 3-year contract with a national chain, would yield $3.3 million in revenue, when analyzed on a monthly basis, the profit is not as beneficial as it first appears. For option 1, the monthly increase in revenue would only be $13,750, while option 2 gives a $16,500 increase, which is 20% more than option 1. Here's a breakdown of our calculations. We can find the total revenues of the 3-year contract in option 1 by multiplying the number of pies requested by the chain by the price the chain will pay per pie. This leads us to the $3,300,000 in revenues that seems so appealing. However, when multiplied by the 15% profit margin and analyzed on a monthly basis, the increase in profits is only $13,750. For option 2, our monthly savings can be found by adding the $13,000 of increased revenue per month and the $14,500 in labor savings. We must then subtract our monthly expenses of $8,300 depreciation and $2,600 of the 20% marginal increase, leaving us with a $16,500 profit, 20% higher than that given by option 1.
So we need to be sure that any investments we make as a company provide the best benefit. In your opinion, which of these options offers us the greatest growth potential?
Option 1 is a short-term contract, while option 2 will generate long-term profits as it lays a foundation for your company to build upon. As you mentioned previously, the labeling process is the most inefficient use of labor for your company. The new labeling machine will decrease direct labor costs across all jobs as opposed to a single client.
The return on investment on this labeling machine is 18%, which is significantly larger than option 1. With option 1, you will not recoup your invested costs within the life of the contract, reflected by the negative 1% return on investment. Another metric for measuring growth is the internal rate of return, or IRR, which helps project how much an investment is expected to grow.
Return on investment equals the gain on the investment minus the cost of the investment divided by the cost of the investment. For option 1, the gain is $495,000 while the cost is $500,000, leading to a negative 1% return on investment since there is a $5,000 loss. For option 2, the gain is $594,000 while the cost is $500,000, causing an 18% return on the labeling machine investment.
Concerned with the amount of risk we expose the company to. Which of these options will offer us the best protection against risk?
Using a conservative approach, we're making the assumption that option 1's 3-year contract will not be renewed. This means that the $500,000 machine will have no use for 7 out of its 10-year life, which causes us to lean away from option 1.
On the other hand, the labeling machine in option 2 can be utilized for its entire lifespan and is available for multiple clients as well as every type of pie. In the long term, this will generate enough revenue to allow for reinvestments internally, leading to better preparations for the future and hopefully many large contracts. Option 1 has the all eggs in one basket approach, focusing all efforts on one client while ignoring seasonal influxes and possibly foregoing attention in other areas, an opportunity cost that cannot be ignored.
Excellent. So you were actually the last group to give their opinions on our investment options. We were going to evaluate our decision, and we were leaning towards option 1, but I think you persuaded us that option 2 is the best fit for our company. And so we appreciate your evaluation, and we look forward to working with you.